Thanks for choosing GoldSeek.com radio as a trusted business and investing news source. January 26, 2022. It's a pleasure to welcome back Harry S. Dent Jr. to the show, well-known market commentary on his website and author of many must-read tomes. Welcome back, Harry S. Dent Jr.
Nice to be back, Chris.
You know, we were talking before the show about market volatility, and you pointed to the NASDAQ, of course, circa the dot-com, dot-bomb as we call it, and then again to 1929 crash, where by 1932 the Dow was off nearly 90%.
Yeah, and I've been predicting this a long time on my demographic cycles. Every generation, about every 39 to 40 years, we get a boom as a generation grows up and spends more money into their peak, which is age 46 today, moving towards 47. And it's a little different in countries, but it's very close to that. So you get a boom every 40 years, and then you get a 12 to 14-year downturn, like 1930 to 42, like 1969 to 82, when the smaller generation comes through and there's less spending until the next generation. And it's always been a bigger generation, okay? So two things going on today. The baby boom peaked but way back in late 2007, as I predicted decades before it happened, just with that simple 46-year lag I call the spending wave. And we went into a deep downturn in 2008, and central banks panicked. Oh my gosh, Ben Bernanke, whose whole theme was studying the Great Depression when he was in school getting his PhD, said, oh my God, we can't have another 30 to 32. And so they printed $1 trillion overnight. And then here we are 12, 13 years later, and they're only considering tapering after, and get this number, Chris, $4.5 trillion printed just since COVID. Before that, in 2009 to 13, after the 2008 crisis, they printed $3.5 trillion. They've never done anywhere near that percentage of the economy. But here we are in the last 2 years, and I've been saying it takes more and more stimulus to counteract a weaker and weaker economy, and they're doing nothing to improve the economy. And the demographic trends, which I'm the expert at predicting, have only gotten worse. I've been predicting not only the 2007 top for decades before it happened, but the 2022, late 2022 bottom in demographic momentum for the stock market. And here we are having stocks go straight up into that. Why? Because they just printed $4.5 trillion, which is, 20 some percent of GDP in 2 years. So that's the thing. The economy weakened for real reasons. The largest generation in history peaked in 2007. They've been printing money, and it takes exponentially more to keep a dead economy going. And that tells you how dead the economy is, that they've had to print so much. And the millennial generation, which only starts their spending wave, by my calculations, in 2024. So we still got this weakness until then. So they don't pull us out of this until then. So I think that if this is what's starting now, may be the first crash of what I call the crash of a lifetime. You have to go back 29, 32, 2 generations back to see a bubble of this magnitude and a crash that, as you said, it was actually 89%. The stock market has never gone that much down in one crash. The NASDAQ went down 78% in 2002. And I think the NASDAQ and the Dow and the S&P are going to go down, I'm estimating 86%. It could be a little less, it could be a little more, but in that magnitude of 29 to 32 for this crash, if we have just begun it. So I'll get into this more, but I'm really measuring now, is this first crash, is this correction that just started in January 4th on the S&P 500, is this the first crash? Because that's the most important, Chris, because that first confirms that you're in a major downturn. But the first crash averages 46% in 2.6 months. And my data now on this one, analyzing, saying this one could be as much as 55 to 58% just in the next few months if we did just top on January 4th. And it's probably going to take me another couple weeks to determine whether this is that first crash, because it has to keep going down. It has to be pretty strong if it's going to go down 40, 50% plus in a couple of months. So we could be in that first crash. So couldn't be a more important time to be re-looking at your stock and fixed assets, and financial assets portfolio and real estate too. This also, like the Great Depression and unlike the 2000 crisis, is going to be an everything bubble. Real estate and stocks and everything have bubbled together. In 2000, it was just stocks. Real estate bubbled after that. So this is going to be an everything bubble. So your real estate and your stocks, all financial assets, except the safest bonds, and I mean 30-year U.S. Treasury bonds. 10-year U.S. Treasury bonds, not as good because the 30-year gives you more kick in a crisis like this.
But with that type of uncertainty and fear, rates will skyrocket, and that would crush the 30-year bond, would it not?
Rates are going up now because inflation, but rates aren't even following inflation here, Chris. See what happens when you have a global crisis of this magnitude. Like you know, there's always this safe haven. The U.S. is more in debt than ever, but Europe has printed more money and has higher debt ratios than Japan and China for an emerging country comparatively. So everybody's in this. We are the best house in a bad neighborhood. So I think the U.S. dollar, like in 2008, people don't believe that. I say go back and look. All the gold bugs tell me gold is a safe haven. U.S. dollar's going to zero. And I say, look at 2008. That was an appetizer for this main course we're about to see. That was the little depression, the little first crash, which they cut off. And here's going to be the big one, more like 29 to 32. Okay, so the dollar went up, and its treasury bond went up 40%. So while stocks were falling 78% on the Nasdaq, 56% on the S&P, and both are going to fall more this time, you could have been making, not just being in cash and preserving your money to rebuy at the bottom, you could have been making money in good old 10 and 30-year treasury bonds and AAA corporates. That's the only thing that does well when you get a bubble, an everything bubble like this crash, because all financial assets go down. Real estate, some more than others, some stocks more than others, but everything goes down. So that is the safe haven. It is not gold. It was not in 2008. Gold was not the same thing, and you can't compare it in the early 30s because it was regulated and manipulated. But gold, 2008 proved gold went up at first in the early stages of that crash. They said, oh, yeah, the crash is gold. Oh, no. When Lehman Brothers went down in mid-2008, gold crashed 50% in a matter of weeks. Gold was not fixed.
I mean, it sounds like you see an everything bubble. Can anybody really argue with the notion of an everything bubble? But there's always a bull market somewhere. What are you looking at? Just cash?
I like the 30-year U.S. Treasury bonds, the longest duration. 10-year will go up too, but the 30-year locks in, and you're not buying it for the 2% yield today, okay? That's terrible, okay? You're buying it because that was the safe haven in 2008 when things got bad, when Lehman Brothers went down. Gold was looking like it might be the safe haven, and then it went down. Now, gold did better than other commodities and did better than stocks, but it did end up down 40, 50%. So it was the only thing that really went up and really spiked up in the crisis was the treasury bonds and the AAA corporate. So the very highest quality, the bonds that will not default even in a depression, those are the bonds that those are the investments, because the money, you're right, has to go somewhere when people sell. It either goes into cash or somewhere. And some people will just go to cash when they panic. But 2008 proved that it was the treasury bonds that were the safe haven. And this is just going to be a bigger version. See, we should have had 1929 to 32 in 2008 to 10, and they cut it off in early 2009 by just printing money. So we're going to have that. We're going to have the bigger crash on the back end this time. In the Great Depression, we had the big crash, 29 to 32, 89%, and then had a second big crash, but not as big, from 37 to 42. So this is going to be opposite. We had the smaller crash in 2008-9 only because they cut it off with massive money printing. This time, if they lose control, we're going to have the big crash on the end, and I think it's going to be 2022 and 23.
Let me play the advocate of the astute listener who's hearing this that you've outlined and might be thinking, this time, though, unlike 2007, 2006, 2007, where there was plenty of wiggle room on rates, okay, to the downside, this time there's nowhere to go but higher. So it would seem like that would make shorter-term government debt, such as T-bills and T-notes, 5, 10 years, more attractive than 30.
30-year locks in your rate for longer, so it has more appreciation. That's the thing. So a 30, I did something in my newsletter not too far back, compared in the type of crash I'm looking at in a change in rates where they go down to maybe from 2% on the 30-year down to 0.5%, okay, and from 1.5 on the 10-year down to 0. That was my scenario. The 30-year went up 40-some percent, and the 10-year only went up 20-some percent. So the longer you lock in the rates and those rates fall, when the rates fall, now even your 2% 30-year bond looks like a winner compared to a 0.5% 30-year Treasury bond. It will go up 40-some percent if that happens. I already did the calculation. So that's what I'm looking for. How do you could be in cash. One thing you can do, especially I just debated Peter Schiff, and I do it a lot, okay, because we both see a similar once in a lifetime crash from the greatest bubble in history, and then money printing and all this crazy stuff, okay. But he sees gold as the safe haven, and I see the Treasury bond. So that's what I look at. What is the safe haven? And I'm using 2008, because you can't. The Treasury bonds did great in the early 30s. Okay, so that I know, but you can't measure gold in the early 30s because it was too manipulated. It wasn't a free trade sort of thing. So that's the question. I use 2008 as the test of what should happen. And like I said earlier, gold did go up at first because people do see gold as a safe haven. Okay, a lot of people. But when the crash hit, when Lehman Brothers went down, and you know what hit the fan, it was the Treasury bonds that spiked up and gold spiked down in the end. So if you like both, you could own both now. But I'm saying if I'm right and we see this first crash, the first crash tells you if we're in something big, because it should be 40%, maybe 50% in just a couple months. So that's why I'm measuring this crash. It just started. This is just a correction now, January 4th, when the S&P finally topped. And there was a whole succession of small caps to large caps and different indices peaking. That's another sign of a long-term top instead of a short-term. So I think this is looking like a peak in January 4th, but we're going to have to see the market go down pretty fast here in the next couple of weeks. And I'm tracking it versus the 2000 crash in the NASDAQ and the 1929 crash in the Dow versus the S&P today to see if we're following that scenario. So far, we are. I'm going to need another week or two to probably determine if we're in that first crash. Then it says we are going to have a big downturn in the 80% plus range, not in the 20, 30, 40, 50% as we get once a generation and sometimes every decade or so. This is going to, and this is the first crash. And my more refined numbers on this first crash using a megaphone pattern, which is very kind of obvious pattern of higher highs coming into this over the last several years and lower lows every time we have a crash. That megaphone pattern is saying this one could be 55 to 58%. The target on my megaphone pattern from the 4808 top, if that was the top, in the S&P is 2,000. That is a 58% decline, Chris. That will set a record. Even the Great Depression crash in 29 only saw, I think, 49% in the first 2.3 months. That was the steepest crash ever. This one would beat that on this first crash. So I'm looking is this the first crash? I think I'm going to have better. It's looking good so far, or bad, if you look at it that way. But I think in the next few weeks, I'll know whether we're in this first crash or not. And if it is, this is going to be the crash of our lifetime. Our kids will have to wait till 2065 to 73 to see something in this magnitude, like 29 to 32. This happens every 90 years.
That's a powerful statement. And, you and Peter Schiff have been excellent friends of the show for 15 years running and mentors to everyone. He's a huge believer, of course, in international equities. And then, of course, the precious metals. You're much more in favor of the T bonds, longer dated.
I also disagree with him. I just debated him 3 times in the last month or so. And it's a great debate if you ever catch it, okay? But I am not a fan of international equities. The U.S. is still the best house in a bad neighborhood. This is going to be a global stock crash, emerging markets, developed markets, everything. And so it really is, there is no place to hide except the safest bonds. And even I look back again at the 2008 crisis. Australia is a country I lecture in a lot, and I haven't been able to for a year and a half, obviously, because of COVID. But they have the strongest demographics of any developed country going in the future. And even their crash last time in 2008 was strong, and their bonds were not the safe. The U.S. was still the safe haven even over their bonds, and they have much stronger economy and demographics. So when things get bad, we're still the number one country in the world. The dollar is still king, and I'm telling you, the dollar will not be king a lot longer going out in the future. There's no way with Asia rising and us getting older and Europe way ahead of us on that we're going to have the dollar is going to dominate 10, 20 years. Now, it's just probably not, but it will dominate. It will be the safe haven, and the U.S. Treasury bonds, I say, will be the safe haven, and gold will not be when the crash really hits. And 2008 was a perfect, proven example of that.
I think you'd agree with us that none of us really knows exactly what Mr. Market will do. You remember what Graham and Dodd pointed out, Mr. Market. And so wouldn't you agree then, at least a modicum of precious metals in case our scenario doesn't pan out exactly?
That's another thing. When Peter and I debate, I usually say to him and say, look, if you're not, because both of us make a lot of sense, and both of us agree that if you don't think this is a bubble, then you're blind. Okay, I can't even compare this. The 29 bubble doesn't even compare to this in magnitude and everything. Real estate was nowhere near the bubble back then. So it's really a matter of what happens when it crashes, and that, you just have to look for the best precedents. And the only good one I have, and like you say, you don't know for sure, especially with something of this magnitude, but 2008 is when this would have started if governments weren't so proactive. Government did not step in and print gobs of money in the 29 to 32 crash. They printed a little. There was nothing, okay? They didn't stop that. The government totally stopped this and took over the economy and has taken over the economy. We don't have a free market system anymore. We have a government top-down run system fed by fake printed money. And that's what Peter and I agree on. But what happens when it crashes? The best reference is 2008, because that was the reason the central banks panicked and started printing money. I mean, Draghi was the first to say, he says, I will print unlimited amount of money. And if you're a short seller in stocks, don't even think of shorting stocks. He literally said that. Don't even think of shorting stocks. They were protecting the markets and protecting the economy. And that means the economy does not get to go out of bubble into rebalance. You just build a bigger bubble, which means when it finally does crash, and I think now is the most likely time, and Peter and I agree on that this is coming to a head now. They're not going to be able to push this out another 3 or 4 years. They've already pushed it out, 13 years, since they started printing in late 2008. So that's why I say 2008 is the best reference, because and gold did not have the freedom. So manipulated back in the 30s, it was just kept at $35 an ounce. Government says it'll be that. It is free floating now. So, and gold did do well in the first stage. So I would my advice would be to get back to that point. I say find a whole gold and 30-year Treasury bonds right now. Do what Peter, but if you start to see the Treasury bonds start doing better and gold start insulting, then I'd say you should listen to me and start getting out of the gold. So I would have no problem people being in both now. At some point, and the bonds will spike in opposite directions. And then so you could sense that if it's happening. If the Treasury bonds keep doing better and the gold keeps doing not as good, that'd be a sign that I'm right and Peter's wrong. So that's the best way I tell people. After they've heard me and Peter debate for 2 hours, I say, look, I know a lot of people don't know, we agree on 80%, but we totally disagree on what happens in the crash. And we totally disagree on Treasury bonds. He thinks Treasury bonds are going to be worthless, and I think gold is going to go down less than other things, but go down like it did in 2008. So I'm using 2008 as the reference. To keep an economy barely growing, that's how bad the economy is underneath, that they've had to print in total $8 trillion, and they're still looking at, doing some form or not, or coming back as soon as the economy gets weak. You just can't. That tells you how weak the economy is. That the Fed alone in just one country has to print $8 trillion, 40% of GDP, just to keep this thing from turning into a Great Depression, because that is what it would have been 2008 did look just like 1930, as I predicted it would decades before, when the baby boom peaked and we came to our first crash and downturn. And they've been printing. That's why governments have had to print so much money. I know that they thought, Chris, in 2009, okay, that, and the first trillion I would have approved. I said, that's good. Print $1 trillion so the economy doesn't overreact as it always does and cause more firms and banks to go in than necessary. But don't keep stimulating the economy and not let the economy rebalance as it needs to do. So 2009, nobody would have thought that 13 years later they would be printing $4.5 trillion in 2 years.
Right. There's been an awful lot of buyback of treasury stock, okay, over the last decade. People forget this, that companies, are buying their own shares because interest rates are low. They can issue debt and buy back, repurchase their own shares. That could be coming to a head, as you say.
It's cheating to print money and not let the economy rebalance and do what it's got to do to deal with slowing demographics. It doesn't change the fact that baby boomers are aging and every one of us is going to die in the next 10 or 20 years, okay? That's the biggest thing ever that's happened to the economy. You can't just print money over that without perverting the economy. So they perverted the economy and then they buy their own debt. They print money and then buy their own debt. It's just like, this is so cheating, so desperate that it should be obvious to people, but they've been doing it so long, people just think, well, I guess it's okay. What I'm saying, Chris, plain and simple, people are not stupid. Something about this seems wrong, that you're just solving a problem with printing the money. They're not cutting costs. They're not rearranging strategies or anything like a business would have to do in a downturn. And that something's wrong with it. And I think when we get this first crash, people are going to say, I knew it. And then they're going to change very quickly and you won't get them. They're going to be selling stocks and selling real estate and you won't be able to talk them into, oh, just hold on and things will be okay. They're going to know. They already know things aren't okay. Why would governments have to print money nonstop and exponentially more for 13 years if something wasn't wrong? People just say, well, it's working. It's okay. No, common sense. I'm sorry. Here's my stand. It's not okay, and this will not end well. And that's where Peter and I agree, that it will not end well. This will be the crash of our lifetime.
Peter Schiff is in his Puerto Rico home.
I'm in Puerto Rico, too. Yeah. Peter moved, I think, just a little ahead of me.
Do you bump into each other on the island?
Yeah. I see him when I go. He's in Dorado, which is the nicest country club development. I'm in Palmas del Mar, 45 minutes away, more than that, away on a whole different part of Puerto Rico, because it is just as nice and more affordable, but Dorado is the place, and that is the biggest real estate bubble I've seen.
You think so? Yeah, all the crypto money. Yeah.
It's gone up 3 times in 5 years.
Why don't you tell people about all the great stuff you're working on at your websites?
Yeah. The best thing, I have a monthly newsletter, but I give updates. And I mean, there's been weeks where I've given 3 updates in 1 week if things are really happening. So I said, we have a free newsletter where you'll hear from me and my partner a couple times a week, a 1-pager. But I would say at this time, we also have a paid newsletter. It's very reasonable, harrydent.com, to get on our free newsletter or to get on our normal newsletter, because I think you should be on Peter and my newsletter, because you can't listen to the normal economists and the politicians and stuff at this time. Everybody's going to tell you this is okay. This is not okay. This is the greatest bubble in history. It's an everything bubble. It's global. It's stocks. It's real estate. It was commodities. They've already largely crashed. But this is the greatest bubble in history, and they only end one way, badly and very fast when it happens. This is going to happen so fast you won't know what happened. And part of it's just an overheated economy so long. There's already the most polarized political stance since the Civil War. Okay, now add to that a crash like 1929 to 32, where people's net worth just gets torpedoed. I mean, I'm just doing a chart for my newsletter showing that the peak of the baby boomers are going to be retiring right now in 2022, 23, 24, right when we could have the biggest stock crash in history. What does that do to you to finally retire and then look at your portfolio? Stocks are down 80 and this is down 60 and real estate's down 50, and you've lost half your net worth or more. And now what do? This is going to be a shock. because the biggest number of baby boomers are retiring right now in this time period, and they're not going to know what hit them when they see markets go down this much.
Powerful comments from Puerto Rico, and we look forward to more commentary from Harry S. Dent Jr. Look forward to visiting Puerto Rico. Do you have to habla español, or is that?
Where Peter and I live, plenty of people speak English. And English is the second language here, and they're always talking about becoming a state or not. So no, this is not like moving to a foreign country. I love it here. My job is to keep my wife here, frankly.
That's great. Thank you, Harry.
Okay.